Hello and welcome to the Allan Small Financial Show. As I always like to say, thank you for taking some time out of your busy day to share it with us. I think we have a fantastic show for everyone today. We have a great guest, Helen Hayes from BlackRock Canada is here. BlackRock, the largest money manager in the world, and she's going to be able to tell us what exactly is going on with the individual investor, where their money is going, and what they're thinking today. I also want to take your questions on anything to do with your personal portfolio, anything to do with what you may be hearing or seeing in the marketplace. We have a lot of things going on right now, a lot of cross currents going on. We have an election down in the US. We have, the market is quite volatile, higher interest rates, higher inflation, Bank of Canada statements, Federal Reserve statements that they've been making recently. All this is playing a big factor into how the markets are doing and how they're behaving. And obviously, how the markets behave is directly related to how your statement looks at the end of each month. So if you have any questions on anything, please feel free to send them throughout the show. And I'd be happy to hopefully get to all your questions at the end of the show before we sign off. So without further ado, let's move on with the show. So on today's show, as I said, we have Helen Hayes, Managing Director and Head of iShares Canada for BlackRock. That'll be a fantastic interview coming right up. We're also going to go through this week. And again, our This Week segment discusses what I think is important for individual investors to consider before they make their investment decisions over the next few weeks. We're going to talk a bit about COVID. Yes, COVID. Something that I don't like to talk about, but I think it's important because as many of you think we're sort of beyond COVID, well, the economy, in my opinion, is not. And I think the indirect effects of COVID are actually directly affecting all of our investments today. We'll talk a bit about that. Canadian dollar. Canadian dollar has kind of hung in there with the US dollar, although it's definitely fallen from the high 70-cent range down to the low 70-cent range, and now back up to around 73, 74 cents once again. Why has our dollar been so volatile? And how is it doing against other major currencies around the world? And lastly, as always, I'll take as many of your questions as I can, answering them as best as I can in the short time that we usually have left at the end of the show. So I'd like to welcome Helen Hayes, Managing Director of iShares Canada for BlackRock, where she is responsible for strengthening iShares leadership position in Canada and deepening client relationships. Prior to joining BlackRock, Helen spent most of her 25-plus year career in capital markets, including at UBS and CIBC. I've had the pleasure of sitting down with Helen before and talking markets and talking everything business. So this, for me, is a lot of fun, brings back memories, Helen. So welcome to the show.
Yeah, thank you so much, Alan. It's great to be here. I'm really looking forward to the conversation today.
Excellent, excellent. I thought, as I always like to do, kind of more of an informal conversation, kind of a chat as to what you're seeing there at BlackRock. In this new era of high volatility, high inflation, and unfortunately, uncertainty, what is BlackRock's ETF outlook for the remainder of the year? What are you seeing there at BlackRock?
Yeah, Alan, I think the markets certainly have been difficult this year. And at BlackRock, historically, we refer to the Great Moderation, which was a period of low inflation and stable economic growth that began in the 1980s. And certainly, I think you'd agree, it's come to an end. And the new regime is a result of pandemic-related implications, unfortunate geopolitical conflict, and global supply chain issues. And all of these things have had impacts to the markets, and as a result, to people's portfolios. And when it comes to implications of sustained volatility, we really view at BlackRock our long-term view remains our North Star of staying invested. And I think you're very much aligned with that, Alan, in terms of how you manage portfolios. And certainly in this environment, I think what we've seen is increased demand for more sustained and I think nimble ways to invest in today's uncertain market. And what we've really seen in periods of high volatility is ETFs have been a really essential part of access to the markets and are key in this transition. So earlier this year, this fall, we put out an updated investment guide. And we identified three key investment themes that I think still stay strong as we head into the end of the year. Number one is embracing volatility. Number two is living with sustained inflation. And number three is the long-term impacts of shortages and how we think about that from a market perspective. And, we look around the world as central bankers try to navigate and balance, the soaring inflation and slowing growth. And I think we've seen risk premiums are certainly on the rise. And so defensive positions have made the most sense, both to minimize drawdowns. And for us, that's a little bit of the new alpha. In equities, we have seen a lot of inflows into minimum volatility strategies in terms of portfolio construction. And that really reduces, Allan, overall portfolio risk and allows the end investor to hedge against potential significant drawdowns this year. Dividend ETFs, certainly no surprise, obviously have been a source for people looking within their portfolio construction in terms of finding that stable income, value, and quality in a portfolio. So certainly from our perspective, whether it's from a U.S. stance or iShares Core MSCI Quality Dividend Index XDU or our MSCI Global Quality Index ETF have all certainly been in favor. And I think, when we think about living with sustained inflation, tips, that's certainly been an area when we look at the structural factors right now in the market. And, everybody keeps wondering whether inflation will disappear all of a sudden. And I think, I don't know what your view is, Allan, but I think it'll stay higher for longer. So I think that argues certainly for inflation-linked bonds over conventional bonds. And our iShares 0 to 5 year tips index ETF, we've got one that's Canadian hedged, STH, has certainly been one where we've seen a lot of inflows. I also think that from a sector perspective at BlackRock, healthcare is another area where we think when you think about sustained inflation and you think about pricing power within the healthcare sector, that's one that we really like as well. And certainly iShares Global Healthcare Index ETF, there's a Canadian hedge version as well. We've seen a lot of inflows there. And I think lastly, long-term impacts of shortages. So, you can't open a paper and not see headlines, whether it's energy or commodity-induced volatility. Going to the gas station, it's costing people way more to fill up their cars. And then obviously food inflation. You go to the grocery store and you're walking in and getting sticker shock from something that's 20% higher than it was the last time you were there. And that might be an exaggeration, but I think, it doesn't take much to see and really feel, Allan, what's happening in the economy at the moment. And certainly from an agricultural perspective, we've seen, excellent flows into global ag ETFs. And for us here in Canada, the iShares Global Agricultural Index ETF, or COW, as it's referred to, has also had a lot of inflows as people have looked within portfolio construction alongside their single stocks. How do we play these different themes?
Yeah, no, that's a great breakdown of what you're seeing. I guess in general, a lot of questions have come to me recently about asset allocation.
Right.
In terms of money flow, do you find that more money has been flowing into some of the more fixed income ETFs or more of the equity ETFs in general? Do you find people are being a lot more conservative over the last 6 to 8 months, or do you still see people trying to take advantage, buy the dips, if you will, in some of these with some of these ETFs?
Yeah, it's super interesting what we've seen this year. And in periods of high volatility, we do see investors turn to ETFs, especially fixed income, which I'll get into. This was an interesting stat that I saw from an update that we had from BlackRock, which was net inflows to ETFs surged to over $110 billion globally in the month of October. And when I look at the quarterly flows here in Canada, ETFs once again outsold mutual funds this quarter. And as of the end of September, Allan, Canadian ETFs gathered inflows of about $25 billion. And, again, we've seen people move to this more defensive stance, whether, as we mentioned already, it's dividend or minimum volatility ETFs. We've also seen that flow into fixed income as well as high yield savings and cash related ETFs, that people have been looking for that yield. And it's interesting, fixed income. So when the pandemic hit, again, I think that is when we really saw the beginnings of whether it's an end retail or an advisor or an institutional client start to think about using fixed income ETFs because they performed so well in the high volatility market at the beginning of the pandemic. And so what's been interesting is with rising rates, Alan, and the environment of slowing growth and inflation, globally at BlackRock, across our iShares, 50% of our global iShares year-to-date flows have come into fixed income ETFs. It's a huge stat. And in Canada, across the ETF industry, fixed income ETFs year-to-date, the last stat I had was about $6 billion in inflows this year. When you break down where people are going, Alan, I think it's a really important point for us to focus on. It's short-dated maturities, so really the front end of the curve, as people are looking to take advantage of bonds that are trading at a discount to par, but again, are on the short end of the curve. So, we have a partnership with RBC. It's RBC iShares. And what's been interesting is to watch between our two product offerings. We've seen strong inflows, over 100 million, or almost actually 150 million in Q3 into RBC's Canadian discount bond ETF, which is RCDB as an example. On the corporate bond side, it's also been quite popular really over the last quarter. So our iShares Core Canadian Bond Index ETF, XCB, and then RBC's Target Maturity Corporate Bond Family. All in all, we have seen almost 400 million of inflows, and that's over the last quarter. So, it's been so interesting how significant it is.
Yeah. I was going to say, yeah, and I guess obviously higher interest rates and the talk, all you hear about on the business channels and all the business folk talk about how you can get into these short-term bonds yielding, 4 or 5%,
yep, when
these products were yielding 1-2 at the start of the year. So I guess in your opinion, with a lot of recession fear, talk of recession maybe as early as first quarter next year, would you say this is how individual investors are managing risk by going into these products?
Yeah, I think it's a combination. I mentioned earlier when we talk about these cash-like exposures, right? And certainly we have seen huge inflows into cash-like ETFs. We've seen big inflows into dividend ETFs, which, as you mentioned, with dividend yields of about 4.5%. We've also seen big inflows into energy and ag. Our XEG, which is our iShares S&P Capped Energy Index ETF, is up almost 60% year to date. So again, people have positioned themselves from an asset allocation model in fixed income, in equities, but in specific areas. Or they've looked to a cash-related ETF from a standpoint of looking for yield that really correlates with where interest rates are moving to. So it's been really interesting to see.
Yeah, for sure. And I guess lastly, for a lot of investors, the term ETF is something that is fairly new to many people. 10, 20 years ago, ETFs were definitely not as prominent as we're seeing today in portfolios. So I guess in closing, what would you say, or how are ETFs playing a role in portfolio construction today? Where are you seeing them being used most at this time?
Yeah, so I think, there's a couple of things to mention on this. And what's interesting about an ETF, it's similar to a mutual fund, but it trades every day. So if you can combine your portfolio construction, Alan, from a single stock perspective, and then you can, in as little as one ETF ticker, investors can build broadly diversified portfolios. So what's interesting about it when we talk about asset allocation and you're making those decisions, when you're building your whole portfolio, ETFs have been shown to deliver that competitive performance, the low cost and transparency. So it makes it easy, efficient, and I think, very accessible. So if you decide, Alan, you want to have a broad exposure like an S&P 500, or you want to have commodity-related exposure. There's ETFs really to solve for that within your portfolio, where you have your single stocks, but at the same time, you want to own a basket of stocks within one ETF. And so they really become an essential building block of investment portfolios, and you benefit from a targeted exposure, lower cost diversification, that liquidity, and that transparency. And I think, again, that is why we have seen ETF adoption, certainly over the last 3 years, really increase. And, we talked about cash ETFs. If I can spend another moment on that, Alan. Cash ETFs have now seen year-to-date $5 billion in inflows. The month of September alone, Alan, cash ETFs had inflows of $1.8 billion, the highest monthly inflow ever. And certainly at iShares, we've seen this show up through our iShares Premium Money Market CMR or our iShares Floating Rate Note ETF XFR. And it's just been amazing. So between fixed income and cash, just the amount. And it's not that people are building entire portfolios. I think within how you think of the world, Alan, it's single stock plus saying, I'd like to get exposure here. And I can, whether it's, again, fixed income or whether it's looking at S&P TSX or composite or megatrends, saying I want to be in global infrastructure ETF or I want to be in global clean energy ETF. You can have all of these from a standpoint of your portfolio construction, which I think it really plays an accessible way for investors within their portfolio construction.
Yeah, it's unbelievable. Those numbers are staggering, and that's why BlackRock is the biggest. Helen Hayes, Managing Director and Head of iShares Canada, thank you so much for being on the show today. It was great to see you again.
Yeah,
and I look forward to seeing you again soon.
Yeah, thank you very much, Alan. Take care.
Thank you. Take care. So this is the part of the show where I talk about what I believe individual investors should be focused on over the next few weeks before they make their investment decisions. We're going to talk a bit about economic data, perhaps maybe even some political data with the elections in the US happening just last night. And I guess kind of lingering on perhaps for the next few weeks. Maybe we'll touch on that a little bit, how that affects the markets and your investment decisions. Talk a bit about corporate earnings. And I guess the overall theme is perhaps not as bad as feared. And lastly, how do you know when you should be adding to an existing equity position? Should you buy more? Should you not buy more? How do you know? So I think it's important to focus on that before you make your investment decisions over the coming weeks. So let's start with economic data or political data. As I mentioned last night, the elections in the US to elect the next Congress, the Senate, the House of Representatives. So far, it looks like Republicans will take the House in a small minority win there, just by a few votes. And the Senate is still up in the air, although many are believing that the Democrats will still hold the Senate. So today, markets are down, perhaps down because of that, or down for a few other reasons. So I think politics, geopolitics, and politics in general are playing a little bit a little bit of a role as to how the markets are doing today. But on an economic data standpoint, we have CPI or inflation data going to be reported in the US as early as tomorrow. Canadian inflation, I think, is coming up in another week or so. You can see here a chart of both core inflation and just overall inflation, still at around 8%, and core inflation about 6.5%, 7%. So inflation is still at multi-decade highs, and that's why we're seeing the Fed continue to raise interest rates. Obviously, all kinds of data that will be released over the coming weeks, whether it's retail sales, whether it's consumers and how they're behaving, their sentiment, how they're feeling, whether they're looking at spending money or not spending money, consumption numbers. All these numbers play a big part as to what the Fed will do at the next Fed meeting coming up, I guess, next month. Bank of Canada will meet next month as well. And all the data that comes out the economic data, political data, geopolitics. I think this all plays a role as to what the central banks will do. And I guess for now, there's a lot of talk that perhaps the Fed in the US and the Bank of Canada here may raise 50 basis points. They may not go 75, but definitely it looks like rates are going to be higher for longer. And I think everyone is I guess coming to grips with that. We could see another hike first quarter of next year, and then maybe we'll finally get that pause that everyone's anticipating. So economic data, pretty important. You can see here a chart on how the US and Canada are trying to close the gap between inflation and interest rates. Interest rates moving higher, and inflation's just starting to fall a little bit. The second topic that I think is important for individual investors to understand or consider are the latest corporate earnings. And as I said a few minutes ago, I think the overall takeaway for me is they weren't as bad as feared. We had some corporations report earnings that were definitely a miss, a lot of them in the technology space, some of them big cap technology, but we also received some really good positive earnings out of some other names in the pharma space, names in some of the banks, JP Morgan, Bank of America. These stocks, I thought, reported pretty good earnings. You can see a chart here. JP Morgan has really been on fire, really, over the last month or so. You can see the dip coming into early October, and really overall over the last 4 weeks, stock has gone from just above $100 a share to $130 a share. It's been on a bit of a tear. Bank of America, you're going to see a tick up higher in their chart as well. And to me, it's no wonder, right? These companies are doing well. They actually do a lot better when interest rates are higher. They get to charge more for the loans that they provide. So banking does well. Pharmaceuticals has done well. Names like Pfizer come to mind. Amgen reported a solid quarter. They have a new obesity drug that is really causing a lot of analysts to take their expectations higher. In Canada, CN Rail reported a really strong earnings report. They're doing extremely well. So overall, I think it's not as bad as feared. However, most of the CEOs are definitely saying they're seeing a slowdown in their businesses. And that's from tech all the way to really retail and anything else in between. So you can see there a chart of Meta Platforms, Facebook, and they've come down quite a bit as well. So overall, not as bad as feared on the corporate earnings, but definitely CEOs are seeing a slowdown heading into 2023. The last topic of the three that I think is important for individual investors, that is, to consider before you make your investment decisions, is this notion of, or the idea of, when is it a good idea to invest more in an investment you have already? For my clients, what I've been doing a lot of recently is buying more of the shares they currently have. So maybe not buying as many new names, but adding to some of the good quality names that they currently have. And I think we have a chart we just showed of Meta. I like to use Meta as a perfect example because I actually received a question from an investor this past week. There's Meta. And they asked me, why would I buy more Meta? Well, with any investment, if you own it currently, if you're going to buy more, I think you buy more of that investment if you firmly believe that that investment will move higher than other alternatives that exist today. So if in this case of Meta, if I believe that Meta has dropped so far right now, and I believe it's still good quality, and we'll get into that in a second, why wouldn't I buy more Meta at the price it is today if I felt that Meta has as good a chance as any investment right now to move higher and make back a lot or some or most of the losses that they've had over the past year? So you want to buy some of the names you currently have if you believe that they're still the best place to be going forward, regardless of what has happened in the past. A name like Meta, approximately 3 billion users use their apps on a daily basis. 3 billion. There's about 8 billion people in the world. So almost half the world's population, half the planet, is using Meta. They have about 2 billion users on a monthly basis. So, if you feel the name like Meta is still good quality, if you feel as though it has come down, but for reasons that they can actually fix, in their case, it's due to the high expenses and the high amount of money, or the amount of money they've been spending on the metaverse, over the past year. If they can get their costs under control, if they can start to cut costs, and unfortunately, they for some of their employees, they actually cut about 13% of their workforce today, or they made that announcement today. So that'll go a long way to cutting costs. Then this could be an investment idea for individual investors to consider, again, if they can handle the volatility and the risk level of the investment. So why would you want to buy more of an investment that you already have, whether it's Meta, whether it's Microsoft, whether it's Amazon, and we have charts of those as well, because you feel the company is still good quality, that the story is intact, that you feel as though if you buy more or buy the shares today, that they would be a good investment going forward. And if you don't buy their shares today, you could always hold on to the shares, but your average cost would still be quite elevated. So if you're going to hold a name like a Meta or a Microsoft or even an Alphabet, Google, you probably at some point want to buy more of those shares to bring down your average cost so you can get back to break even quicker. So what I've been doing for many investors is exactly that, buying or continuing to buy good quality names at a lot cheaper prices, because I believe these names will be the names that you can own for defensive purposes, but also will be the names to rebound first when this market turns around. So this is the part of the show where I want to talk a bit about the effects of COVID. And I know COVID's a word we're all tired of hearing, but it is something, in my opinion, that's still affecting markets today. I don't think you have to look any further than to take a look at what the Federal Reserve is doing. The Fed is continuing to raise interest rates at a time when inflation is very high, because they're hoping to bring down inflation. They're hoping to slow down the growth in the economy in the US, and the Bank of Canada is hoping to do the same thing up here. They're hoping to reduce the amount of jobs being offered right now, the amount of job openings. And they don't really like to say this, but they're actually hoping to see the unemployment rate tick a little bit higher. Well, that would be great. And that is kind of the playbook that the Fed or central banks use in a higher inflationary environment. However, I think you have to start to question whether this is what you want to do coming out of a pandemic, coming out of COVID, because during COVID, everything was shut down. Coming out of COVID, we have a shortage of labor. Businesses can't find enough people to work. We're seeing wages rise because there's not enough workers out there. We're seeing countries like China shutting down because of a zero COVID policy. So the Federal Reserve and Bank of Canada can raise rates all they want, it seems like, but that's not really affecting the unemployment rate. It's not affecting the slowdown. It's not causing a slowdown. The economy is still moving along. And my worry is that the Fed or Bank of Canada will continue to raise rates at a very rapid pace and overshoot their mark, so that we go from everything is okay, Canada grew over 100,000 jobs last month, to all of a sudden no jobs available or very few jobs available, and an unemployment rate that starts to tick higher and higher. And in my opinion, when you let that genie out of the box or that genie out of the bottle, it's tough to get it back. It's tough to start to grow again once you're trying your best to slow things down. And that's my worry. And that's why I think COVID is affecting us still till this day. Not so much from the health perspective, because I know a lot of people seem to have gotten over the pandemic at this point. But from an economic standpoint, I think COVID is making things a lot difficult, or coming out of the pandemic has made things a lot more difficult for the Fed and the Bank of Canada. Their playbook, in my opinion, cannot be the same at this time. They need to find ways to increase supply versus dampening demand. And as long as businesses are still looking for people to work, businesses are still trying to grow and need people to grow their business, it's going to be very, very difficult and very challenging for central banks to slow down this economy, to slow down the amount of money there is out there, slow down the wage inflation. And that's really what the Fed and Bank of Canada are looking at right now. So for those that have taken a trip down south recently, maybe gone across the border to Buffalo, did a little shopping, we're obviously noticing that Canadian dollar is a lot lower than it was start of the year. And in my opinion, I think it's obviously has to do a lot more with US strength than it does with Canadian weakness. It's interesting though, if you were to compare our dollar, the Canadian dollar, to some of the other major currencies around the world, you would find that our Canadian dollar has actually stacked up pretty well. It's actually quite strong versus the pound, the euro, the yen, etc. It's just the Canadian dollar versus the US dollar that gives us a bit of a, I don't want to say disadvantage, but we've seen a pullback versus the US dollar. And whenever the world is nervous, bit of chaos out there, we tend to see a lot of investors and a lot of money flow into US dollars, US treasuries. And we've seen that over the first, let's call it 10 months of this year. And here's a chart which shows our dollar versus the US dollar. Now, you can see in this chart right at the end, our dollar's actually picked up. We got as low as 72 cents Canadian dollar versus US dollar recently. But when we received the most recent jobs report in Canada, grew over 100,000 jobs when we were expecting nothing anywhere near that, maybe 10,000 jobs created. That actually gave a boost to our dollar. And I think what it told investors is that perhaps our central bank is going to increase rates for longer, that the next rate hike might be another 50, followed by maybe another 50 in the new year. And then who knows from there. But I think it gave an indication to investors that our central bank is going to continue to match what the US is doing. And obviously investors like that. A lot of money flowed into our dollar. And we saw our dollar move up $1.50 to 2 cents over the last few weeks. And I think that's why you're seeing some of the strength that we've seen in the Canadian dollar recently. But make no mistake about it, the US treasuries are above ours. The 2-year, the 10-year, the 5-year government bond rates in the US are well into the 4.5% area for the 2-year, actually 4.7% in that range, kind of getting closer to 5%. US treasuries are higher than ours. And I think this is having obviously a bit of a negative effect on our dollar. Keep in mind, we do have oil up here. Oil has definitely helped. A higher price of oil, we are still looked on as a petro currency to some degree. So that has helped stabilize our currency versus the US. They're more technology in their markets, a little less oil. So that has helped as well. But overall, I guess the main message and main takeaway is our dollar is strong versus the rest of the world. It's just unfortunately a little weaker when it comes to the US dollar for now. So this is the part of the show where I take a few questions from you, the audience. Anyone have any questions, please send them to me. If you don't send them now and I don't get to them now, we will definitely try to address them on the next show, or perhaps even during the week if I get some messages from all of you or any of you that has a question regarding your portfolio, how it's performing, what's going on in the world of finance and how the economy is doing. You can send me a message anytime. So let's see if we can get to a few questions in a few minutes that we have left. I see a question here. What is the difference between investing my money through an advisor at my local bank or using an independent investment advisor such as yourself? Is my money more protected if I stay with the bank? Fantastic question, and something I think maybe a lot of you are thinking. Is the bank safer than in investing it with an independent like me? Well, I guess the good news about myself is, yes, I am an independent. I am affiliated with IA Private Wealth, and IA Private Wealth is a division of Industrial Alliance. Industrial Alliance, one of the largest Canadian insurance companies. IA Private Wealth, amount of money and assets they manage, one of the largest investment firms outside the banks, if not the largest outside the banks in the country. So anyone who invests with IA Private Wealth, with myself, you definitely have the comfort of knowing that I'm affiliated with a larger entity. Here, what is the difference between investing my money through an advisor at my local bank? Well, I think when you use an independent like myself, I think we just have more goodies in our bag to use, to provide, to offer individual investors than someone at the bank branch level. A lot of times when I see portfolios coming from the bank, they tend to have bank products in them. Perhaps you own a bank product through the bank. I would hope that I guess the advice you're getting is unbiased. As an independent, I don't have any proprietary products, so whatever I'm recommending, it's because I think that individual investors will do well by owning what I'm recommending. There are no underlying fees that I'm being paid or anything like that. So I just think that when you use an independent, at times you can get that unbiased advice, that non-cookie cutter approach to investing. I know a lot of financial institutions have more of a cookie cutter approach. When you invest through myself as an independent, you get unbiased advice, and I don't have a cookie cutter approach. I build all portfolios from scratch to meet the needs and the goals of my individual investors. Let's try and take one more quick question. I know we're running out of time here. Let's see here. What is the optimal age to start investing in the stock market? That's an easy one. As early as you can. I know I started investing when I guess got my first job, my first full-time job in my early to mid 20s. And I started putting away some money at that time into mutual funds. And then from there, I progressed into individual securities once I started to amass enough money that I could actually buy individual stocks and bonds, etc. So I think you're never too young to start investing. You're never too old, obviously, to invest. And for those that are approaching retirement and watching today, if you think you don't have a lot of time because you're approaching retirement, I don't agree with that. Understand that in retirement, you may take out money to live off of, but you're never going to take the whole portfolio in one shot. You're going to take small pieces at a time, and whatever's left will stay invested. And so once you start investing, there's probably a good chance that you're going to be invested for the rest of your life until you're no longer with us in some capacity. As I said, you're never really going to use it all up. You're going to use pieces at a time. So even in retirement, you're still going to be an investor, and something to consider, because I know a lot of people think that as they approach 65, 70, that their days are numbered as an investor. And that's really not the case. It also depends on not only time horizon, but it also depends on risk tolerance as well. So never too young, never too old, invest. And I think that's the best advice that I could give anyone watching. So with that, I think I'm going to close the show. Thank you again for watching and taking the time out of your busy day to watch. Hopefully you took something out of the show today, either from Helen Hayes from BlackRock or from some of the topics that I mentioned. And I look forward to seeing all of you 2 weeks from today for our next show. Have a great 2 weeks.